The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A rebound in U.S. economic growth spurring a rebound in economically sensitive stocks. Live from Bloomberg's world headquarters here in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Let's get a check on where markets stand right now, because we started the day with Wall Street in recovery mode from yesterday's big sell-off thanks to the latest batch of economic data. Those gains have since faded. You can see the S&P 500 unchanged at the moment. The Magnificent Seven actually in the red, down 0.1%, although Tesla is bucking that decline, actually higher today. Remember, the Mag 7 yesterday fell almost 6% as a group. The S&P 500 yesterday tumbled 2.3%. The Russell 2000, though, clear outperformer. So small caps, that rotation into this group is still intact for now. And we're looking at yields lower for mostly across the curve. The 10-year down 2 basis points to 4.25%, Romaine.
Yeah, the move in yields and the move in the Russell really tied to one big number, and that big number of the day has to be 2.8%. That was real U.S. GDP growth in the second quarter, more than a percentage point higher than in the first. A major economic data point that should be warmly embraced by the Fed and is already being embraced by investors who are sparking another day of outperformance by small cap stocks versus those large caps. We'll get back to that in just a second, because while a big rebound in personal spending did help stoke those official GDP numbers from the past quarter, look ahead to the next quarter. Some bumps on the horizon, at least if you believe the commentary out of several corporate executives, Stellantis, Whirlpool, Nestle, United Airlines, just to name a few. Consistent commentary about how a multi-year inflation cycle has finally put real pressure on household spending. And that is the conundrum for a Federal Reserve that has been seeking to stick that economic soft landing, a landing that Mohamed El-Erian, as well as Bill Dudley, says could too easily slip away if unhelpful, noisy data delay an interest rate cut beyond September. Take a listen.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. If the Fed doesn't cut in July and waits till September.
Bill Dudley there. And Scarlett, this gets to the trickiness here of that soft landing, right? I mean, the fine line between a Goldilocks scenario and, well, a downturn is fine indeed.
And that's why everyone's obsessing over every economic data point that does come out. So let's circle back to today's batch. And the centerpiece of it really was GDP. And as you mentioned, it showed the U.S. economy grew more than forecast in the April to June quarter at a 2.8% annualized rate. It's a clear sign that demand from both consumers and businesses is holding up under the weight of higher borrowing costs. The print is up meaningfully from the 1.4% rate in the first 3 months of this year. Now, some analysts say that this report reinforces the idea that the central bank has the benefit of time and therefore doesn't need to rush a rate cut in July, but it puts more onus on doing something in September.
All right, let's kick things off to the close with Diane Swonk, KPMG's chief economist. So, of course, on the heels of a very encouraging gross domestic product report. And Diane, with the caveat, of course, that's looking backwards here, it's still a pretty significant improvement from what we saw in the first quarter, not just on the headline number, but really when you open up the hood and look at where those personal spending dollars actually went. Were you encouraged?
Absolutely. I think this is as close to use the word I was going to use, as close as a Goldilocks scenario as the Fed's going to get right now, because what we saw was consumers push back. They were defiant in the first quarter. They didn't spend on goods. And then we saw major retailers, vehicle producers who said they'd never, reinstate incentives again. Yes, they are reinstating incentives now. Lots of lease incentives, lots of incentives, even on the markdown on price. Remember, just a few years ago, we were talking about above sticker price on many things. Those shifts actually brought consumers back. And that is encouraging. But, there are things that people are worried about, and that is that we've seen an increase in unemployment. Most of that's due to more people looking for jobs. But we also know that those who have lost a job are taking longer to find a job. We know that the jobless rate for new college grads has moved up more rapidly than the overall college graduate unemployment rate. And so there are some cracks in the foundation, and you don't want those cracks to spread to become larger fractures in the foundation of the labor market.
It gets to a point then when you look at the state of the economy or the general health of it and this idea of whether you want to call it soft landing, Goldilocks, et cetera here, does this create a situation for the Fed, as Bill Dudley and Mohamed El-Erian said earlier today, kind of forces their hand to do something sooner rather than later? Or do you think they have the luxury of waiting?
Well, I don't think they're going to do anything until September. I think that there is still a need for them to feel really confident. And let's face it, we saw what the ECB did. They cut, and now they're sort of caught in a, no man's land of pausing because they've seen stickier service sector inflation. We need to see that goods deflation continue to offset more structural inflation in the service sector. And there are still things out there that could pop it up. We also know every time mortgage rates really come down, now the consumers have held back a little bit. There's a lot of pent-up demand on the sidelines, but the supply picking up at the same time when mortgage rates do come down, that those millennials can finally buy the homes they want to buy. You need more inventories out there, or you're going to push prices back up again. So it is a hard thing to do. And let's face it, when the Fed got the soft landing in the wake of the 1994 hiking cycle, in 1995, they cut rates after we actually saw red ink on unemployment for 2 months. It was later revised away. But it was, it's a bit of a luck thing that was actually a soft landing.
So I got to ask you about the other side of the Fed's mandate, which is, of course, maximum employment. We get the jobs numbers next week, and there's going to be a lot of focus on whether there's a weakness in unemployment or in employment that would push us towards triggering the SOM rule, an early recession warning. How have expectations for the jobs report changed or shifted as a result of this latest batch of data?
I'm not sure it's changed all that much, but there is a risk. I mean, we're 0.7 basis points. I mean, it's 0.43, 0.5 on the SOM rule is that it's, signaling it could be a recession. Even Claudia has been sort of forthcoming and saying it doesn't, it's not clear. It's the same thing in this kind of environment. And we do know that much of the increase in unemployment has come from an influx of workers looking for jobs more than layoffs. But like I said, there are underlying cracks where those people who are laid off are finding it harder to find a job, and new college grads are finding it harder to get a job once they graduate. And those are things we have to watch for. So, it could trigger the SOM rule next week. I don't think the Fed is as focused on that as some others are, and maybe Bill Dudley is at this point in time. But I do think it is one more piece of information that we have to watch because we've had a lot of momentum, and that's been great. Today's orders data was also good. But there are places where it's weak, and the housing market is one of them. And consumers at the bottom of the income strata, the bottom 30% really, don't have any savings left, and their credit cards are compounding at very high rates.
Yeah, I'm glad you bring that up because I'm curious to get what you think is happening with the corporate results that we are seeing lately. This idea of revenge spending, which has really supported the economy for so long after the pandemic, has kind of given way to reluctant spending. People are spending, but they're being very, very selective about how and when they do so. What earnings reports have you seen that really raise your concerns?
Well, I can't talk about any specific companies,
Sure.
but I think what you're starting to see is some of the pushback on margin compression. And that is exactly, what retailers did. Big box discounters were the first ones out of the box to say we're going to roll back prices. They set the tone for the entire industry. We saw fast food chains also give discounts out there. That's very important as well. But all of that compresses margins, right? And it's a volume play over a margin play, but it does mean that it's much more difficult to get that extra earnings out there. And I think that's exactly what we're seeing. And what you want is that's part of the Fed's strategy and what they were trying to do. But on the flip side of it, you just don't want it to hit a tipping point and accidentally hit a tripwire where all of a sudden that means more layoffs as those margins compress further.
All right, now I give you the tripwire of a political question here, Diane. Everyone is focusing on the election this year, more from the perspective of how any shifts in fiscal policies could either help or probably hinder some of the progress that the Fed has made on inflation. Any concerns there?
There's lots of concerns. There's lots of things out there. When you talk about tariffs and immigration policies, those tend to be higher tariffs, which we've just seen. Actually, we saw hedging. We saw one of the reasons we saw the increase in inventories in the second quarter was because people were buying ahead of tariffs that just went into effect. That's going to continue, but the more tariffs you get out there, they are inflationary. That's a problem. The more you curb immigration, which has helped to balance labor markets a little bit more, the more inflationary situation and then you've got the Fed raising rates instead of cutting rates. So there are policies out there that we have to think about. But at the end of the day, I think one of the most important things to note is that although we all judge the economy now, we know that consumers do it through the lens of their partisan affiliation. There is a reality to what is being experienced. Many Republican strongholds saw a lot of migration from very wealthy states and wealthy consumers into their areas. That bit up inflation in those Republican strongholds, and they actually experienced more inflation than former Democratic strongholds. And so the divisions we're seeing are also real economic differences. So, when I talk about the economic data, it describes everybody, but no one in particular.
Yeah, absolutely. Inflation on the top of a lot of voters' minds. It'll be interesting to see if that drives the results. Diane, always a great conversation. Diane Swonk, KPMG's chief economist, helping kick us off to the close here on this Thursday afternoon. When we come back, a closer look at the market moves, that rotation into small caps. It continues. Ralph Schlosstein, Evercore's chairman emeritus, going to be joining us to talk about this rally in the riskier corners of the market.
Plus, the biggest IPO of the year. You have shares of Lineage popping as the storage and logistics giant makes its public debut.
And what's the future for Warner Brothers Discovery after missing its shot on holding on to its NBA rights? We're going to speak to Macquarie's Tim Nollen, who just downgraded the stock in today's top calls. All that and more coming up in a bit. This is The Close on Bloomberg.
Season is here.
We're skating into another earnings season.
The expectation for earnings going forward are quite high.
Bloomberg is first to break the numbers.
Adobe earnings crossing
earnings out of Broadcom.
JP Morgan, we get Citigroup, we get Wells Fargo.
There is something for everybody.
With the smartest insights.
Now banks have earnings power.
There's a resilience in the bigger cap companies.
We're not talking about a collapse in earnings for technology.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
We, set out to build a forever company when we started this, and we never tried to time the market. We just wanted to take good long-term decisions to continue growth at scale, which is what we've been doing. It was just the right time for us to be a public company, to have the right cost of capital, to have the fortress balance sheet, to go out and continue to bring in the best assets in our business and to invest in our customers' growth.
Lineage co-founders there ahead of the company's public debut. Shares of Lineage, of course, moving higher as the temperature-controlled storage and logistics giant began trading today. They raised about $4.4 billion. Again, the year's biggest IPO. Bloomberg's Bally Lipschultz has more. Yeah, and of course, Romaine is impressed because we thought the IPO market was dead.
Can I do my joke first? $4.4 billion. That's cold, hard cash.
You've been rehearsing that, right?
Yeah.
It's been rehearsing
I'll just see myself out. Yeah.
All right, so this heralds what? The comeback of the IPO market?
I don't know if I'd go that far. It is the busiest week since ARM after Labor Day last year, which everyone thought that was going to be the deal that helped open the IPO market. Shortly after that was Instacart. A little bit later was Birkenstock. But we did have the market really correct back in the fall of 2023. So biggest deal since then. We do have the busiest week since that week. Expectations had been high. I mean, I call it a 4 1/3% rally is kind of in line with what some of the buy-siders I've talked to were expecting. Not really a huge move, just given the fact that $4.4 billion is a lot of money, and it is a REIT, so it's not like OneStream, which we saw pop 34% yesterday.
Yeah, I mean, it's interesting, too. I mean, when we talk about this company's business and this idea that there might, obviously they see a lot more demand for cold storage, particularly with people ordering more medications online, groceries, other things like that. They keep in. What's like the growth story here? Because when we talk about the post-IPO performance, the secondary market performance here, it seems like we've seen these IPOs fizzle out pretty quickly because no one can really articulate what that longer-term growth story is going to be.
Well, it's a lot of putting money to work. So when you look at the REIT space in general, acquisitions are kind of what you raise cash to do. So that's when we're looking at the REIT space, not only do you have a catch-up trade over the last few months of valuations getting better, still nowhere near some of those AI names. But when you look at the underlying business and the expectations that they can put cash to work, that they continue to grow through some of these bolt-on acquisitions, that actually is the strategy, as opposed to, a technology company that maybe has been waiting in the wings for 4, 5, 6 years, who hopefully is just going to continue to grow its bottom line.
And at least this seems somewhat unique. I mean, I don't know how many other publicly traded cold storage REITs there are, but
yeah, that's very specific.
It's new to me.
It definitely is niche-y. We spoke with the CEO of the NASDAQ Stock Exchange earlier today. Let's listen to what she said about not just Lineage, but companies coming to market.
The monetary policy outlook and other geopolitical, factors, I think, are still keeping investors a little bit more risk they have a little bit more risk aversion. But we're seeing some real good progress, and we think that going into 2025, we should see more momentum in terms of the pipeline of companies that we've been talking to.
So that brings me to my next question. What does the pipeline look like end of 2024 and into 2025, where a lot more is expected to come on?
Yeah, the big focus right now is really that second quarter 2025, which ironically this time last year, everyone was saying second quarter 2024. So wishful thinking that we're still 3-6 months away from that return. But the big expectation is you'll have the uncertainty around the election in the rearview mirror from at least a banking perspective. Likely you will have a few interest rate cuts. You should have kind of a more normalized environment for some of these smaller companies. So there's a lot of excitement about who could go in 2Q. We do see, the likes of a StubHub still being floated as a potential fall target. Mm-hmm. But the big thing is, and when you look at, again, Lineage, $4.4 billion, when I talk to people on the street, that's signed, sealed, delivered, the biggest IPO we'll see in 2024. So moving to 2025, you could see some of those bigger names like a Stripe or a Databricks 2025, 2026 timeframe.
All right, Billy Lipschultz here. A closer look at the IPO market. The new kid on the block, Lineage, Scarlett, selling last night at 78, opening today at 82, pretty much where it's trading right now. And it was interesting, too, about cold storage, too. I mean, it kind of sounds esoteric, but I had an interview with the Carrier CEO a few months ago, and he was actually talking about this was a big opportunity, particularly overseas. And then I even noticed in my apartment building here in New York, they actually put in a fridge.
When they take deliveries?
Where you get package deliveries? Yeah. And they put in like this industrial fridge. And I said, what's that for? And they said, so many people are getting medications and other things that needs to stay cold until they come home. And food deliveries as well. So they felt compelled to, I guess, spend, part of our fees on this new thing.
Does this mean that dry ice companies, they're hurt by this? I don't know.
I like the way you think, Scarlett Fu. All right, when we come up, we're going to talk about Warner Brothers Discovery here, a downgrade today on the back of them losing the rights to the NBA to Amazon. It's part of our top calls, and it's up next. This is Bloomberg. All right, let's get a view from the sell side. Top calls, the big movers on the back of analyst recommendations. And we're going to start off today with Lamb Weston, the maker of French fries and other potato products, getting several downgrades after a disappointing earnings report. Bank of America dropping its recommendation to neutral, saying the industry is entering uncharted territory as companies weigh greater price concessions given weaker sales volume. Also peeling back the price target on Lamb Weston down to 66 from 109. The shares peeling back by 5% down below 54. Next up, Lululemon, not fit for a buy rating over at Citi, a downgrade of the athleisure brand to neutral. Lululemon actually telling Bloomberg that it's halting sales of its breeze-through yoga wear, a move that the analyst says signals weaker trends and leaves Lululemon more susceptible to increased competition and promotional pressures. Lululemon having one of its worst days in at least a year. And finally, let's take a look at Warner Brothers Discovery. Macquarie downgrading the stock to neutral, with the analyst saying WBD missed its shot with the NBA by losing out on those broadcast rights to Amazon. He calls it a huge loss of a core content asset for both the linear network and the Max streaming service, and he now expects the company to accelerate any plans to break up. Shares down about 5%, now camped out right at $8.03 a share. Woof. Those are some of our top calls, and pleased to say the analyst behind that last call is joining us right now, Tim Nollen, senior media tech analyst over at Macquarie. Let's get right to it. I mean, there was a lot of concern here that they were going to lose this NBA contract. They had a chance to bid. They had a chance to outdo Amazon's bid. They chose not to. Do you think that's going to be a mistake?
Well, in a way, that's the conundrum, isn't it? They've had an exclusive for a long time, up until April or so, and then they didn't take advantage of that. And then they've had a few months since then to try to fight and match. And evidently now it's going to go to the courts. So it's unfortunate. And it's probably a function of Warner Brothers Discovery being a little bit hamstrung financially, given the debt load that they've got. And perhaps not completely clear on whether they really wanted the NBA or not. I mean, they said at one point they don't need it, and now they're suing to try to keep it. So uncertain what was behind the thinking there. But I do think it's a big loss for TNT and for WBD as a whole.
You're referring, of course, to David Zaslav, the CEO of Warner Brothers Discovery, saying in May at an RBC investor conference, we don't have to have the NBA. Clearly, you don't agree with him. To what extent can you trust what he says then going forward, Tim?
Oh, I don't know about that. I mean, it might have just been a public posturing comment. I don't know what was behind it. But I do think the NBA really was important, or maybe still is important for WBD if they can somehow manage to win this lawsuit or whatever's going to happen next. But, it's an important component, not only to the linear networks, which a lot of people are worried about right now, given the downturn in advertising, which is probably structural for linear, and given the loss of potential bargaining leverage on affiliate fee renewals. But I'm more concerned about the Max streaming service because streaming is the present and future. It's a very competitive space. They've got a great offering with some deep studio content, HBO, Warner Brothers Studio, Discovery lifestyle content, lots of great stuff there, kids programs. And until fall of 25, a lot of sport. But you take the NBA out of that, and that critical sports component goes away. And I just think it's really unfortunate because it would have been a very good way to draw and retain users to the Max streaming service.
Yeah, I am curious about that too, and I guess it raises the question as to what the strategy ends up being for Zaslav. A lot of questions about how this company might be broken up. That does seem to be the impetus that Zaslav brings to the table. Do you think that's going to happen, and if so, how quickly?
Oh, I don't know. I mean, there is certainly corporate intrigue across the media space these days. The larger companies with the budgets to support streaming services seem to be in a better spot.
Yeah.
And the smaller ones are struggling. I don't know if a breakup. Look, there was an article last week in the FT talking about this. I don't know how realistic it is, but there is activity afoot underneath the waves, and so maybe a breakup is a way to release value from the linear network separately from the studio and the streaming.
I just have to ask you another quick question here, Tim, and this is more about content creation, and this is just some breaking news that came out just a little while ago revolving the video game makers and SAG-AFTRA basically authorizing a strike that effectively starts tomorrow and does affect Warner Brothers. It affects their peers as well. And of course, we're coming off of that actors and directors strike from a year or so ago here. Are you concerned at all that if we see another major disruption in content creation, that could provide another big headwind for valuations?
If this is news that's just come out in the course of today, I've missed it. I thought you were referring to something from last year. But yeah, that was disruptive. Another strike would be disruptive. I mean, they're just kind of crawling out now from the delays to production from the strikes last summer. So it's hardly what the industry needs at this point.
Yeah, very well said. They need to get going with the production. Of course, that costs money, and that's another issue entirely. Tim, really appreciate your joining us today. Tim Nollen over at Macquarie on his downgrade on Warner Brothers Discovery. Coming up, we've got Ralph Schlosstein. He is Chairman Emeritus of Evercore, joining us to discuss his outlook for the U.S. economy and the markets, the rotation into small caps. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. Romaine, you look at the major indexes. They've been up, they've been down, they've been up again. But what's remained steady throughout today is small caps and how persistent that advance has been, that outperformance since that June CPI report a few days ago.
And it all seems tied to the perception of economic conditions being better than they are. And of course, the speculation that we're going to finally start to get some rate cuts that could actually help out some of those small caps. And let's face it, it was higher interest rates to a certain extent that led to the small caps being such laggards. But really over the last, 12, 13 sessions, they've really bounced back.
And it's not just small caps, right? It's the other 493 companies in the S&P 500 that aren't the Magnificent Seven. You can see the equal weight S&P 500 has beat the S&P 500, the weighted S&P 500, for a third straight week. So let's talk a little bit more about some of the drivers behind that rotation. Let's bring in Ralph Schlosstein. He is Chairman Emeritus of Evercore. Ralph, it's so good to see you here in our office.
It's great to be here again.
Thank you for joining us today. What are some of the assumptions that are being rethought here as investors, looks like, are much more convinced that the other stocks that aren't the Magnificent Seven and small caps really have some ways to go here?
Well, first you have relative value. The multiple at which those stocks trade is dramatically lower than the Magnificent Seven. Second of all, as you pointed out, those stocks are the ones that are most negatively affected by higher interest rates. And I think it's pretty clear we're closer to interest rate cuts by the Fed, and that is helpful to them. The one thing you didn't mention, which I think is very important also, is that small caps tend to be more domestic in their sales.
Good point.
And so given the relative outperformance of the U.S. economy compared to the rest of the world, that's also a benefit to small cap stock and mid cap stocks.
And absent in your answer there was the benefits of the big technology companies. I mean, they are still making a lot of money, maybe not as much as investors would have liked. But do you see anything in the results and what they're saying that's worrying when it comes to how much they're spending on AI and how much it's showing up in the results?
I think almost any time when there is this world-altering technological change, you go through a cycle. The first burst of that cycle is massive spending. Then there is a part of the cycle where people say, well, what's the return going to be? And then coming out of the other side, there are companies that will be massive beneficiaries of this new technology. So there'll be a sorting out. My guess is that collectively, we'll see as much, if not more, benefit than we expect. That's typically what happens with massive technological change. However, it won't be universally shared by all of the companies.
I am curious, though, about what's driving that change. I mean, when you started your career, we were kind of going through a different type of technological change. Some of that aided, or at least seeded, we should say, by government involvement, government policies, government investment. We're kind of there again, though this seems much more corporate-driven, though we know the Biden administration would like to be a little more involved. Do you feel, though, that the changes that are coming, even if they're not shared by all, that this is that inflection point, whether it's for investors, whether it's for the end user like ourselves, that this is that big inflection point?
Well, I think there are a couple of interesting things that are very different, in my view, about AI versus Google and Meta and Netflix. And that is that AI is something that literally is going to improve the performance of almost every company. For the first time, we're having technological change that significantly affects the jobs of service workers, white-collar workers. And so every company is going to improve their productivity and their margins utilizing AI. It's going to take a while to happen. And there's interesting thing is that it's likely that the greatest beneficiaries will be hardware companies and companies that have deep intellectual capital, almost consulting advisory type capabilities, as opposed to the big land grab that you had in direct-to-consumer businesses like Google and Meta and Apple.
One other thing that seems kind of interesting about this phase, as opposed to the last big technological phase, was how many companies in this space are still private, meaning that for a whole cohort of at least public investors, they don't necessarily have access to be able to get in on the ground floor the way a lot of private investors have come. And I know that's been a broader change that we've seen in investing overall, where private markets have been, at least for a certain investor class, much more accessible than the public markets.
Well, I think the reason for that is a couplefold. Number one, these companies don't generate any earnings. So valuing them in a public market is a little bit more challenging. The second is they're materially more risky than the average public company, and therefore are more appropriate for large, deep-pocketed institutional investors who, by diversifying, can afford to have some, what we call in the investment business donuts, where a lot of money is invested and it winds up being worthless. So that's, in my view, best done in the private world. I think if you look at the last set of technological innovations, you take a company like Amazon. So Jeff Bezos brilliantly put the pedal to the metal for 20 years and created a category killer of a company. If you go back 20 years, logically, Amazon should have been created by Walmart. They had the customer base, they had the countrywide distribution network, they had all the things, the logistics that Amazon had to build. Why didn't that happen? The reason is there were 20 years of negative income statement to build a huge terminal value.
Right.
We would have probably had 5 CEOs of Walmart over that period of time if they had tried to do that, and the board would have been attacked by activists every year.
Yeah.
So it's very hard in a earning public company to do these terminal value investments.
The patience is just not there, right, from public investors. I want to get your take on politics because I know that you are a supporter of Vice President Kamala Harris. You back her campaign. What is the best argument you can make for why she is good for the U.S. economy?
Well, I think if you look at the accomplishments of the Biden-Harris administration, and quite honestly, I've been mystified why the president and the vice president haven't focused on this more. Many of the things that they accomplished were things that President Trump talked about and did nothing about. He talked about bringing technology and semiconductor jobs back to America. You know, the Biden-Harris administration passed the CHIPS Act. He talked about lowering drug prices. Nothing happened. Biden and Harris have actually lowered the price of insulin and allowed for the first time Medicare and Medicaid to negotiate on certain drugs. And so I think if you look at the infrastructure, another one, you will recall President Trump talked a lot about infrastructure.
There are a lot of infrastructure weeks.
And in reality, Biden and President Biden and Vice President Harris were able to get a bipartisan bill. By the way, all 3 of these things that I talked about were done on a bipartisan basis. Right. So I think if you look at the accomplishments of the Biden-Harris administration they are high relative to the rhetoric. If you look at the Trump administration, the rhetoric was high and the accomplishments were not that great. Someone said to me, or I heard it on one of the news shows the other day, you know, Trump wasn't so bad if he were a silent movie. I would say it the other way. If you just listened to him and you didn't see what he was actually doing, you would think he was actually accomplishing something, when in reality he didn't get that much done.
All right, Ralph, I've got to leave it there. Always great to talk to you, and wonderful insights as always. A lifetime of experience on Wall Street, chairman emeritus over at Evercore. Coming up here, we're going to take a look here at some of the big movers on the day, including the surge in shares of Bally. News of a buyout offer. It's our stock of the hour, and it's up next, right here on The Close on Bloomberg. All right, time now for our stock of the hour. Taking a closer look at shares of the casino company Bally's, up about 25% here on the day. This on the news as Standard General has agreed to acquire the remaining shares that it didn't already own. Abigail Doolittle joining us now for a little bit more on this. They own about a quarter of this company at 35% premium, it looks like, based on yesterday's closing price here. Overall, it seems like a pretty good deal, certainly for Bally's. Is it a good deal for Standard General?
It certainly seems like a good deal for Bally's, considering the stock is down about 80% from its peak. If we look at the other numbers, this year, this company's modeled to a $9 loss. That's incredible. I mean, it's more than $9. I can't remember the last time I saw such a big loss, and it was a big loss last year. Margins are dropping by a couple 100% this year and next year. As for Standard General, it's sort of interesting in a fact because they own the Queen Casino, so they're hoping to fold this thing into it. Queen Casino has 4 casinos, whereas this Bally's has 15 casinos in 10 states, a horse racetrack in Colorado, a golf course in New York, an online gaming operator as well, plus the sports betting platform dubbed Bally Bet. Almost 1,100 employees. So what I'm trying to say here is, from an operating standpoint, to fold all of this in, It's not going to be the easiest thing. One thing to point out, the stock is having a nice pop today, but it's a 35% premium. The stock's up about 25%. So there are some people who think maybe this deal isn't going to get done, or there's going to be some challenges.
And the Queen Casino entertainment business that Standard General currently owns operates 4 casino properties, as you mentioned, so it's a lot smaller.
Yes.
Is there going to be any kind of regulatory resistance to this?
It's interesting that you should ask that. It seems unlikely, but on the one hand, one thing to consider is that there are some horizontal similarities. From a geography standpoint, 3 of the Queen casinos are in Louisiana. One of Bally's is. That would be the one point of concern. Outside of that, probably unlikely. However, the FTC, super active, and right now it seems as though there's bipartisan support for cracking down on deals. More in technology, but who knows, maybe there will be an issue here.
All right, great stuff. Bally's currently up by 25% on this buyout offer from Standard General, the hedge fund, for $18.25 a share. Thank you so much.
Yeah, I'm always curious as to how casinos lose money. I mean, $9, what'd you say, $9 a share or something? Yes. I mean, like, I thought this was just a license to print money.
Right.
You basically just hand them money, they spin a wheel, and then,
There's definitely room to redo this and restructure this somehow. All right, Nadia Lovell joins us next with the countdown to the close.
AI is something that literally is going to improve the performance of almost every company. For the first time, we're having technological change that significantly affects the jobs of service workers, white-collar workers, and so every company is going to improve their productivity and their margins utilizing AI. It's going to take a while to happen.
The chairman emeritus over there at Evercore, of course, a lifetime of experience on Wall Street from his days in helping to found BlackRock to the old Lehman Brothers days. So he really understands kind of these inflection points in market cycles. And I do wonder if that's what we're seeing, particularly with yet another day of outperformance with the small cap stocks.
Absolutely. You take a look at what's happening and the big cap stocks, the S&P 500, for instance, down about 0.2%. The NASDAQ off by 0.5%. But you look at the S&P equal weighted index, up 0.4%. That rotation into things that aren't big tech is definitely taking hold, and certainly the Russell 2000 continues its outperformance. Ralph was talking about how it's going to take time. We all knew that coming into this AI story, but at some point during this earnings season, investors were like, no, I need to see something more right now.
Yeah, and it's interesting too. I'm glad you put up the equal weight there, because when you look at the cap weighted index and you take a look at where the S&P is down on the day, despite the fact that the majority of stocks, more than 300 stocks in the green.
Overwhelming, yeah.
But that might be an encouraging sign, because that is your rotation. Basically, the other 490 names, or in this case, 318 names, but still, I think that's what a lot of people really wanted to see. Let's get you down to those closing bells here. Nadia Lovell joining us right now, senior U.S. equity strategist over at UBS Global Wealth Management. And Nadia, when we talk about this rotation, a rotation that now looks like it really is a little bit more sticky. People are encouraged by the potential for a drop in rates. They're encouraged by numbers like those GDP data that we got this morning that seem to suggest a relatively decent economy, or at least an economy that will be more favorable to small cap names. You see that?
You know, we are neutral officially on small cap, so we do think that it is important to have some exposure. But I would say that we are a little concerned about the durability in small cap, and particularly the strength and the velocity that we've seen in this rally in small cap. You know, it's not really fundamentally driven. It's really being driven by macro factors and positioning. We have seen investors close out their underweight and also a bit of a short covering. And so valuation multiples have expanded in the last few weeks for small cap. And so that gap between large cap valuation and small cap has narrowed. They're still trading at a discount, though, to the large cap peers, but on an absolute basis, not so much anymore. And what we've been seeing consistently, even through this earnings season since the start of the year, is downward revision to small cap. So, yes, agree that in terms of a Fed cut could help alleviate some of the balance sheet concerns and refinancing concerns around small cap. But really want to start to see that earnings growth come through for this to have any sort of real staying power and become not so much a trade and more of an investment.
And it's interesting, too. I mean, when you look at the complexion of this small cap rally, a lot of that is still tied to financials, a few kind of cyclical type of names like in the materials space, et cetera. But then when you get down to tech and discretionary, even on a small cap basis, you're not seeing as much love there. And I'm wondering if that's indicative of investors' concerns about those macro conditions.
I think partly, I mean, some of it has to do with just positioning that had been within the tech space. So we are seeing that rotation continues. But, the complexion of that could change next week when we have some of the more less cyclical and more defensive areas of tech report. What we have been advising our clients globally, more tactical clients coming into quarter, was to position a little bit more defensively in tech. But now you're starting to see some of these, semiconductor names that are now in correction or even, bear market territory. So the risk reward set up in some of these earnings are a little bit more attractive. Now, there's concerns around whether we're sort of entering a CapEx bubble, and that remains to be seen. We don't think so. So we do think that the AI story is still with tech, and we do expect these companies to reinsert their leadership by the time we get through this earnings season.
Talk a little bit more about what your clients are doing. We came into the second half of the year, and there was a lot of anticipation that people wanted to put money to work. Is that what you found when you talked to your clients, that they wanted to put money to work, or were they fully allocated and pretty happy with where they were and wanted to continue to see how that would play out?
Yeah, there is still, as we know, a lot of cash on the sidelines. I would say what we're seeing more, because we are a global wealth management firm, we do see in terms of outside the U.S. in particular that a lot of our clients are underexposed to the U.S. market and actually underexposed to tech, and where we see opportunities. And so we're starting to see some pickup in activity there, but clients still have dry powder to put to work. And so we would look at this sort of rotation that's happening, and also the broader pullback in the broader market, because reality is you need mega cap tech to be able to participate for the broader S&P, the S&P market cap to be up. Another leg down in this, we would look to that as a buying opportunity. We ultimately think that this is a market that could get to 5,900 by the time we get to the end of the year. And so we tactically looking to add if this market continues to trade down.
Okay, got it. Thank you for explaining that. You mentioned that small caps are trading at a valuation discount to large caps. Would you say that valuations of the most popular trades, and here we're talking about big tech, of course, anything tied to AI, have reached what one analyst called stupid levels?
I maybe in some of the small cap space, but I would say in the large cap space, valuations aren't cheap, but I don't think that they're definitely not bubble territory or overly exuberant, because reality is the earnings growth is coming through for these companies. Yes, there's been some chatter and a lot of much ado about potential for mega cap tech's earnings to decelerate in the second half of the year. We know a lot of these companies has been growing at over a 30% clip for the last 4 quarters. This quarter, they'll probably put up another 30% plus growth. And so some of these companies, particularly given the pullback, will be growing into their valuation multiples. And so we don't think that valuations are, in sort of bubble territory. And as long as the earnings are following through, these companies can continue to perform well.
Nadia, always great to talk to you. Nadia Lovell there, Senior U.S. Equity Strategist at UBS Global Wealth Management, helping us count you down to these closing bells with about 3 minutes until we get there here. A bit of a complexion change here or at least in the aggregate markets here. The S&P and the NASDAQ now falling deeper into the red, right around lows of the day. The Russell still clinging to some pretty decent gains, up more than 1%.
And this is kind of something we've seen during this rotation out of those big cap tech stocks, is that in the last hour of trading, instead of kind of rallying into the close, we start to see a little bit of a swoon, especially on days where things were a little bit mixed to begin with.
And don't forget, maybe some of that is also some concerns that we have a big economic data point coming out tomorrow that could change the complexion of the market once again, depending on what it says. And of course, we're still heading into the real meat of the earnings season next week, where you get the Microsofts and Amazons and all those types of names.
And then, of course, you've got the Fed next week, and you've got the jobs report on Friday.
Absolutely. So a lot for investors to chew on here as that rotation in the equity market continues. The VIX elevated on this day, we should point out, back to the 18 level at one point, trading at 19. Our full coverage of all the market moves coming up right now, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu here to take you through the closing bells. Our global simulcast, it starts right now. Carol Massar and Tim Stenovic joining us in the radio booth. Alex Steele has the day off. Welcome to our audiences across all of our Bloomberg platforms, including our partnership on YouTube. That rotation, Carol Massar, into small caps, out of big caps to a certain extent, continues for yet another day.
Absolutely, a rotation, but I feel like we've been kind of back and forth, some hesitation in terms of certainly the S&P and NASDAQ in terms of what direction it wants to go. So I would say volatility continues to kind of be back in I feel like a big way. You've got the VIX going above 19 today. So I do feel like investors are kind of trying to search for what is the next big trend line.
And I'm trying to go back. I don't think we've seen it this high almost all year long, right?
Right.
Yeah.
It feels like it's been a long time, right? Yeah.
It's interesting to see after yesterday, Romaine, I know you were out, but I don't know if you heard there was a major sell-off.
No, I did not
on the S&P 500.
Oh, was it? Okay.
Yeah, so the rotation, but it wasn't a rotation into small caps. That's the thing. So that kind of took a pause, but the fact that it's back on, I mean, I don't know, was yesterday's sell-off a harbinger of things to come or just sort of a one-off?
You know, if you put it in context, yes, we extended yesterday's sell-off, but now the S&P 500 has fallen for 6 days in the last 7. You look at a chart and it's starting to look definitely like we've plateaued and maybe we have definitely reached that inflection point.
Yeah, and just a clarification too on the VIX, we did get above that 20 level back in April of this year here, but still at an 18. Yeah, but still at an 18 reading here. Some territory we haven't been in now for about 3.5 to 4 months. We get the closing bells here in New York. A mixed day once again here with green on the screen. At least if you are in that small cap, mid cap, or cyclical space, the Dow Jones Industrial Average higher by more than 80 points, or about 0.2%. The S&P taking a leg lower, down about 0.5%. The NASDAQ also lower by about 0.9%. The NASDAQ 100 down more than 1. As for those cyclical names, Dow Transport's up 1.3%. The Russell 2000 up by a similar amount, 28 points, or about 1.3% on the day.
I might remind everybody, too, though, we're still up, I think more than 30% since that October low back in 2023. Having said that, Scarlett, today you've got 290 names in the S&P 500 gaining ground, 211 to the downside, 2 unchanged.
All right, let's take a look at the sector performances because you'll see the heaviest weighted sectors doing the worst. You've got communications services down 1.9%, technology losing 1.2%, utilities, okay, not a heavily weighted sector, but down 0.9%. The ones bucking the decline, energy up 1.5%, industrials and financials and materials. So again, some of that cyclical flavor coming back. And just worth noting here, for the Russell 2000, all 11 sectors in the green.
Yeah, exactly. All right, guys, let's get to some of the individual gainers, if I may. ServiceNow, it is your number one gainer in the S&P 500. Stock up almost 14% here, jumping the most in more than 12 years. That was at least on an intraday basis. Got to check here at the close, reporting better than expected quarterly sales and bookings that signaled strong consumer demand for its broad suite of software tools. So that was certainly an outperformer. Old Dominion Freight finishing the day off its highs. It was up 8% at its highs, finishing the day just shy of 6%. It was the number 2 gainer in the NASDAQ 100. The trucking company reported earnings per share for the second quarter that did top the consensus estimates and a return to double-digit EPS growth. Analysts weighing in, several, including Raymond James, BMO Capital, raising their price targets on that stock. And real quickly, Hasbro was up more than 9%. A lot of stuff going on, I feel like, in the toy area, as we know. Up more than 9%.
Are toys back?
Our toys are back, but they're also, whether or not there might be some deal activity. We talked to the Mattel CEO yesterday and denied it. But nonetheless,
I feel like there's a little arc, right? The more they deny, the more it's true.
I don't know, but it's just kind of interesting. We tried to push. Hasbro, though, it did beat expectations in the second quarter. Also boosted its earnings forecast for the full year.
Who pushed harder, you or Tim?
Carol did. I play good cop.
I know.
Oh, is that?
Yeah.
Oh.
They have a strategy.
Well, I guess that makes sense. Yeah, Carol, bad cop. I get it. Okay.
Ouch. All right, I'm going to give it to the good cop now.
All right, but I get the decliners. Some really notable ones today. I do want to start with Ford. It's having its worst day since the depths of the financial crisis, going all the way back to 2008. Shares falling more than 18% today. A big earnings miss. The automaker blamed it on a surge in warranty repair costs for older vehicles. Recurring quality problems have driven up Ford's warranty costs for years, but an $800 million spike in the second quarter caught investors by surprise.
I'm totally fascinated. And I think you guys had the Ford CFO on yesterday or something.
You guys did, yeah. John Lawler.
Yeah, because I'm curious. I mean, this basically sounds like it's a Ford issue, like a production issue, right?
Yes.
Yeah, and a lot has been written about it. I think our own Keith Naughton had a big story about it a couple months ago. But he called it a one-time jump due to quality-related issues. But the market is not seeing this as a one-time thing. And this is not happening just at one time.
Yeah.
So.
I bought a car yesterday.
Oh, you did? Is that why you were off?
Yeah, I did. Yeah.
What'd you buy?
He's contributing to the U.S. economy.
What'd you buy?
A Bentley.
Oh, wow.
It was used.
That
don't
checks
worry.
out.
It was used. Save a little money.
The maintenance costs, though, Romaine. Okay.
The insurance costs.
Yeah, we'll chat after the show.
Wait, I need insurance on that thing?
All right, let's talk Chipotle. Shares falling 1.85% on the day today. This after the company said it'll spend $50 million on making sure that workers serve the right amount of food. We're talking about 2 generous scoops of rice and 4 ounces of meat in those burritos and burrito bowls.
Bring it on.
You guys know there have been those complaints about portion sizes, right?
Yeah.
Wells Fargo analysts last month, they came out with this note. They said that Chipotle's portions varied widely after going to 75 different restaurants and getting identical burrito bowls in New York City. So the company's listening, and it's going to cost them. Shares of Lululemon falling to their lowest in more than 4 years after analysts raised fresh concerns about the company's ability to hit financial targets due to ongoing product execution and slowing activewear trends, falling 9% today. And finally, I do want to do an honorable mention with Edwards Life, down 31%. Biggest decline since 2000 when it fell 41%. Did you guys see this?
Yeah, huge deal.
Yeah, the maker of heart valves reported sales for the second quarter that missed the average analyst estimate. Also announced a couple acquisitions for $1.2 billion, but investors not liking it.
All right, we do have some earnings crossing the wire. Let's take a look at Norfolk Southern. The shares oscillating between gains and losses, though the company did beat on all of the major metrics. EPS in the most recent quarter coming in at $3.25 a share, a big beat over street estimates of $2.88. On an adjusted basis, it's $3.06 versus $2.87 on a revenue basis. This is where a lot of the optimism is right now. The company posting its first quarter of revenue growth in 5 quarters here and providing guidance for the full year of about 1% to 3% growth on the revenue side.
All right, we also have numbers out of Skechers USA. Second quarter EPS 91 cents. That is down from 98 cents a year earlier. Adjusted, it was 97 cents, and that does beat the average analyst estimates by 2 pennies. Net sales of $2.16 billion, weaker than expected. The consensus estimate was for almost $2.25 billion. So that might be why you're seeing the stock fall in after-hours trading. Also, just worth mentioning here, Skechers board has authorized a buyback program, $1 billion of its own shares.
Yeah, we'll see if that does anything to turn around the stock. But as you said, still down about 6% here in the aftermarket. Stock in 2024 just up 2.5% here, Tim.
Okay, we're going now to Deckers Outdoor, the company reporting numbers now. First quarter net sales coming in above estimates at $825.3 million, beating estimates of $807.8 million. Sees fiscal year gross margin of about 54%, saw about 53.5 to 54%. Our estimates were at 54%, so coming in line with expectations. Sees fiscal year operating margin at 19.5 to 20%, saw about 19.5%. Shares up in the after hours about 1%.
And it's interesting, too, because we talk about that GDP report that we got this morning, obviously a big bump in personal spending. And then at the same time, you're getting all of this commentary from companies saying that the consumer might be a little stretched. But then you look at these Deckers results, even the Skechers ones. I mean, this is pretty decent growth. I know it may not rise to the occasion for some people, but 22% for basically a shoemaker on a quarter-to-quarter basis. That's pretty impressive. And then again, you overlay that with what you were talking about, Carol, with Old Dominion, and even the results we got out of Norfolk Southern right now. There's some bright spots here in this economy.
It really depends on what you're selling. I think in the case of Deckers, they have been able to not cut their prices, not discount their wares. So there's full price selling going on. And this is something that was expected. And in fact, the incoming CEO talking about how fiscal year 2025, because this is the fiscal first quarter, is off to a great start. Hoka and UGG delivering fantastic first quarter results, contributing to the increased outlook for the full year.
And the Santa, is their strategy just like to have ugly shoes? Is that it?
That's Deckers, right?
Yeah.
Did you know that I'm wearing Hokas right now? Is that
I
what
did
you're
not,
saying?
but they are ugly.
Are they
I haven't
giant?
seen them.
About my shoes.
And you have Uggs. I know that's a fan favorite of Scarlett's, right?
Yep.
Teva, Sanuk.
So rude.
Yeah, Kookaburra. Oh, okay, there we go. Sorry.
It just shows consumers are still spending, right? Go back
Did
to
you just call me rude?
Which one?
You're insulting his footwear.
I didn't hear anything.
No, but it shows, right? Goes back to that GDP report. Consumers are still spending. We should point out that's backwards looking. Let's see what happens, whether or not that continues. But always so important, right, in terms of our economy. So I bet
$8.80 a share on Deckers right now.
I bet Romaine has Uggs at home.
I do not have Uggs at home.
Uggs, I bet like those platform Uggs.
There
that
are
just
no
came
Uggs
out.
in my household. Like
I believe there are no Uggs.
There's some
no
Crocs
Uggs allowed
in our household.
No Uggs allowed in the Bentley.
Yeah, so exactly.
I think
no shoes in the Bentley either. I got that nice plush white carpet. Can't be messing that up.
All right, on that's a wrap, guys. Our crowd platform coverage on radio, TV, YouTube, Bloomberg Originals.
Do you think Romaine will let me be the driver? like I can drive him around in the Bentley?
You can at least polish it a little.
No hokas allowed in there.
Okay.
No, indeed.
Okay.
All right, guys, we'll see you tomorrow.
And coming up, our coverage on Bloomberg Television continues a closer look at what's going on in the retail and apparel sector with those results from Deckers just crossing the wire. Dana Telsey on tap, founder and CEO of Telsey Advisory Group. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. When we talk about what happened in the markets today, rotation is probably the only word that you can use. It's a word that we've used in at least 12 of the past 14 sessions with the outperformance, once again, of the Russell 2000 versus the broader market. A more than 1% gain on the Russell, a 0.5% drop on the S&P. But you look at some of the more tech-specific indexes out there, and you get a better sense of that big rotation. The Philadelphia Semiconductor Index selling off in a big way, Scarlett, down about 2%. But we should point out, not everything in tech got sold off. Tesla held up, and a few other companies in the tech space also got bids as well.
Yeah, ServiceNow, ticker NOW, is one of the biggest gainers in the S&P 500, and the AI story clearly working for this enterprise software company, climbing to a record high after its second quarter sales and bookings topped analyst estimates. The CEO, Bill McDermott, credits the beat results to Gen AI, which is helping provide some relief to the overall broader software group, given all the questions on whether the increased CapEx is actually paying off for a lot of these companies. I'm also paying attention to Eli Lilly, down 4.5%, 7-week low for this stock. This is after Viking Therapeutics, a smaller biotech name drug developer, said it is advancing its weight loss shot into a late-stage trial and also looking to explore a monthly dosing of this new drug. Of course, you know that Eli Lilly has made the Mounjaro weight loss drug. It's helped it become the world's most valuable health company with a market value of over $800 billion. Today, it dipped below that level, that milestone level. Romaine?
All right, let's take a look here at some of the earnings that are crossing the wire here in after hours trading. That includes Texas Roadhouse. Those shares up about 3%. Abigail Doolittle joining us right now to walk us through the earnings here. I know you must be a huge Texas Roadhouse fan. You know, can I just tell you, years ago when I used to live in Virginia, there was like one across the street from our office, and I was there like all the time. I loved it.
So were there any vegetarian offerings there?
I was more of a burger and a beer kind of guy, but no.
So I'll have to go and explore there. But they put up a great quarter. Apparently people like it the way that you do. They beat both top and bottom line estimates. Very, very impressive. Adjusted earnings, they beat by a couple percentage points, $1.34 billion. Actually, that was in line, not a beat, but very strong. Beneath the surface, super important, commodity cost inflation, 2% for the full year versus the expectation of 3%.
That's good.
Yeah, it's great. I mean, especially given the fact you weren't here yesterday, we were talking about potatoes. Potatoes not selling well in part because of price inflation, but they must not be seeing that there. The restaurant margin.
I had potatoes yesterday. Yeah, we were at this restaurant. They had these like jalapeno mashed potatoes.
So that sounds really good. Lamb Weston.
I was going to say, did Lamb Weston make those?
I don't know. Apparently not.
But the restaurant margin, 18.2%. That was a beat by by more than 100 basis points. Michael Halen, our restaurant analyst, he's super encouraged by the fact that the 5-year same-store sales trends accelerated by 130 bips to 55.4%. And what's so interesting here is on the year coming into this print, and the stock is higher on it, the stock up in a big way, up about 36%. The comp group down 12% because we do have this burgeoning weakness in restaurants, but apparently not Texas Roadhouse.
Yeah, interesting.
All right, good stuff. Thank you so much, Abigail Doolittle, with the instant analysis on Texas Roadhouse earnings. And, you know, it's so interesting to see which companies are doing well and which are struggling in this current environment where revenge spending has been replaced by reluctant spending or very, very targeted spending.
Yeah, and it's interesting too. I mean, we talk about the differences in this economy, that there are some people doing well and a lot of folks that are really making hard choices here. We didn't necessarily see that in Texas Roadhouse's results, but we've heard from other restaurant companies basically saying that they've seen a trade-off. Either people aren't coming in or they're coming in to eat but not necessarily buying as much as they would. And you're seeing the same thing at the retail level. People still shopping, but maybe being more selective about what they buy.
And as a result, a lot of the companies are forced to do these promotions, these aggressive promotions that may or may not pay off.
And just real quickly, because we remember Diane Swonk said this at the start of the program. She talked about with vehicles, how they're seeing a lot more incentives. And as you know, I just bought a Bentley yesterday. And believe it or not, they actually, there were a lot more deals. We had been looking for a car for a long time, and it was like same thing. Everything was marked up. Everything was marked up. Now it's MSRP or lower.
So you got the Bentley for lower than the MSRP?
Yeah, I mean, I had to buy in the tire package or whatever. You showed
up in your spiffy suit and everything?
No, I actually just showed up in rags. I wanted to think I was as poor as possible.
Buying a Bentley, that worked. All right, let's talk a little bit more about what's going on with the consumer and the retail environment overall. Deckers Outdoor, which is, of course, the parent of UGG and Hoka, did report results and looks good, right? The stock is up 3.6%, and a lot of this is due to the strength of those two brands in particular. Deckers Outdoors sees its full-year earnings per share of $29.75 to $30.65. That is an increase to its previous guidance. Dana Telsey, again, joins us now. She's founder and CEO of Telsey Advisory Group to talk a little bit more about this. So Deckers is really hitting its stride here with both UGGs and Hoka. How much of this do you worry is a trend that could fade as time goes on because consumers are picky and they move on to the next thing? And how much of this is here to stay?
Keep in mind, I thought the results, as you mentioned, and thank you for having me, were better than expected. Look what was in the release when they talked about full price global demand for both UGG and Hoka. It's been the pace of newness with the product innovation that they deliver that's driving the attraction because of all that new product innovation. You've seen overall, both for Hoka and UGG, the DTC penetration keeps rising, and that's encouraging. And most importantly, the 56.9% gross margin was better than expected. I think overall, as long as they keep innovating, they're continuing to see demand, and you're still in earlier innings of Hoka to expand their assortment and the categories that they compete in.
Okay, that's super interesting. And I want you just to compare and contrast what Hoka's doing, what Deckers is doing with Hoka to what Nike's been doing, because they both have that focus on DTC, but clearly you're saying it's paying off for Deckers with the full price selling.
I think one of the things that's different is they've had an increased pace of product innovation for a longer period of time. So the new products that they're introducing, they are very selective in how much they introduce, when they introduce it. This is not pushing it into the marketplace. It's about a pull-through in order that they sell the whole combination of the product assortment. I think the demand and desire for Nike products overall, it needs to accelerate, and their pace of innovation hasn't been as great as what you've had at Deckers. I think it's ingrained in the culture of delivering newness, and that's what's showing up in the results.
Is this kind of I hate to use this phrase, but when we talk about this idea of companies kind of being recession-proof, or at least having much more of a moat should economic conditions deteriorate, is this one of those companies, or at least its structure, that there's enough there at different price points where even if we do hit an economic downturn, people will continue buying?
I think we've hit economic downturns with this company, and we've seen volatile ups and downs. Certainly not every line item is perfect. It doesn't all go up and to the right, but they have enough there that it's driving the overall increase in sales and profits. I don't think anything's recession-proof. I don't think you can say that. I think it's the agility with which the management team operates the business that helps them go through the economic ups and downs.
With regards to their marketing strategy, it seems like, we know UGG's has a kind of its own life to it, but I felt like Hoka's kind of came out of nowhere. It was almost like viral. It just was kind of word of mouth, and then all of a sudden everybody was wearing them here. How do you feel about their marketing spend or their marketing strategy, and whether they should make any changes or tweaks to it?
I think it's working. I think they're capturing a wide audience, whether it's millennials, whether it's Gen Zs, and even Gen Alphas. I think the look of the product and, frankly, the new selections that they're introducing are compelling. And they're in the early innings of opening stores in Hoka. And let's see what they do with category extensions as apparel is being added to the mix.
So where's the weakness here? What's the risk to this name, to how the company pulls this all off?
It's all about growth rates. I mean, companies are valued in the stock market based upon growth. Accelerating growth rates gives higher stock prices and higher PE multiples. The ability to continue to show growth rates that accelerate and come in higher than expectations, higher than the guidance, will allow this company to keep generating big stock price gains. You're certainly seeing it here with I think you had mentioned earlier, up just over 3%. The call's first going to come up at 4:30, and let's see if there's any updates to what they're expecting for Hoka and UGG for the balance of fiscal 25 sales growth rates.
Yeah, I'm looking at Deckers, and it currently trades at about 26 times earnings, 27 times estimated earnings. Nike trades at 22 times estimated earnings, and On, the Swiss sneaker company, trades at about 41 times estimated earnings. What could the company say, Dana, that would encourage you and reassure you that it's got its eye on the ball here? It's doing the right thing in terms of innovating the Uggs and Hokas and continuing to come out with new product line that get investors excited.
I think you're seeing it. I think you're seeing it in terms of, as they've talked every quarter about new introductions that are coming out. I think it's a little bit about the new store openings, and it's also about new customers coming into the brand, retention of existing, and driving repeat customers. I think some of the category extensions, like some of the trail that they're going into with Hoka, is exciting, and you're seeing that sell through, and you're seeing them begin to capture market share. Hoka didn't just come in overnight. It's been over 10 years that they've been working to drive Hoka to be a brand of relevance.
All right, Dana, always great to talk to you. Dana Telsey, founder and CEO
Thank you.
over at the Telsey Advisory Group. We should point out Decker shares now up more than 9% here in after-hours trading. If that holds into the cash session, will be one of the strongest days in at least a year. Meanwhile, to the downside is Boston Beer, Sam Adams, ticker SAM, down 5% here on the back of its latest earnings report. And it looks like an interesting miss on the bottom line, $4.39 for EPS in the most recent quarter. The street was looking for $4.89. Revenue also coming in light at $579 million, though the company is saying that it does plan to meet its full year EPS forecast. So we should point the range it's giving is pretty wide, $7 to $11 a share. The average of street estimates is near the top of that range. So that might be a part of the reason why you're seeing the shares move lower.
They're also forecasting 2024 price increases of 1% to 2%. So that inflation story continues to live on. Of course, if you were to just look at that compared with PCE or CPI, below the 2% target that the Fed looks at.
1% to 2%. That's like, you won't notice that, right? If you go
still
in,
feel it if you
buy a six-pack and it's up like 5 cents. You're not going to notice that. Does Jay Powell know about this?
I think we got to alert him.
All right.
Coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close.
Shares of Dexcom down more than 30% in after-hours trading. The maker of diabetes equipment providing a forecast that came in well below what the street was looking for here in the second quarter. We should just point out they did miss estimates on both the top and bottom line, and their forecast for the full year revenue forecast also coming in light as it is for the third quarter here. We should point out, Scarlett, this is the second medical device company today that we got earnings from that elicited a huge share price reaction to the downside.
Yeah, Edwards Lifesciences tumbling as much as 28% today on its disappointing results. All right, let's get you to the top three now, where we focus on the people driving some of the day's most talked about stories. And first up is Kathy Hochul, the New York governor, being sued over her decision to put the city's traffic congestion pricing plan on indefinite pause. The plaintiff is a nonprofit advocacy group, and it wants the courts to force the New York Department of Transportation to implement the plan.
Yeah, it's interesting. She just gave an interview, I think it was last week with Bloomberg, where she kind of talked about this is a pause, not a cancellation. But as we knew, these lawsuits would probably be coming as it deprives certain agencies of money that they need. Someone I'm keeping an eye on, none other than Zuckerberg, Mark Zuckerberg, the CEO of Meta. When he gave this interview, sit down, something I didn't notice, but apparently all the internet noticed, was this tan line that he has on his face here. Now, some people are saying that's not glasses, that's not from goggles, it's from some kind of AR, AI device that apparently he's keeping secret to the world. Now, he did respond to this saying that they were from Ray-Bans, is what he said. But, of course, the conspiracy theorists on the internet say no.
No, but you know what? He has a history of putting a lot of sunscreen on his face. This is him 4 years ago surfing in Hawaii. He was wearing so much sunscreen, people thought he was the
haunts my
Joker.
dreams now.
Yeah, but so like you think he knows about that, but just something to keep in mind there.
Okay.
All right, finally, Rupert Murdoch, the 93-year-old media mogul, acted to change the family trust that governs his estate to favor his son Lachlan. Now, this is according to the New York Times, which saw some court documents. This is real-life succession drama, Romain, except this time the mogul actually favors the eldest son.
This is what I love about it, that he is picking favorites, because I always say parents, they never have any favorites. You've got multiple children. You don't have to say which one's your favorite, but I know which one it is. You're going to be.
So does Rupert.
Are you going to be Rupert Murdoch one day when you're doing out your will?
I don't have that kind of money to give away, so not an issue.
All right, sit with us in a minute. An exclusive conversation with Colin Kaepernick. This is Bloomberg. Welcome back to The Close. Colin Kaepernick, he made headlines back in 2016 for his political views and activism, both on and off the football field. Today, the former NFL quarterback making headlines once again, but this time for dipping his toes into the vast lake that is artificial intelligence. Kaepernick launching a new company that uses AI tools to help creatives navigate some of the barriers that come with producing, marketing, and distributing content, and he's got the backing to do it. $4 million raised in seed funding led by VC firm 776. Without further ado, we're happy to be joined exclusively by Colin Kaepernick, founder and CEO of the AI company Lumi. All right, Colin, let's get right to it here. I mean, give us the idea, the genesis of this idea, because I'm told it had something to do with the media company that you had started prior to this.
Yeah, absolutely. The media company I had started prior to Lumi, as well as the publishing company prior. We faced a lot of barriers there in helping creators both create, the expense, distribution, and also the gatekeeping within the industries. So we looked at those barriers and found a solution to be able to help creators solve that and to be able to do that at scale. And I think that's really important. And the last piece that's important there is creators also own all of the work that they create. So they no longer have to be commissioned hires. They no longer have to create for somebody else. They have freedom to create what they want and have that independence.
This sounds like one of those opportunities when we talk about kind of whether you want to use the word democratization or kind of removing those barriers. And we've seen this already. Of course, social media has a lot of people who wouldn't otherwise have had opportunities to become stars or make a ton of money, to do so in a way that bypass those traditional avenues here. How will Lumi help to do that using some of these AI tools?
Yeah, so the interesting part is sometimes creators have gaps in their skills. So sometimes illustrators, they need help with writing, or writers, they need help with generating images. And if you're a creator like me who doesn't have either of those skill sets, we'll help you with both of those to get to a final product from an original idea. And then once you have that final product, we'll help you publish it, distribute it, and then also merchandise your stories. Mm-hmm. And one of the goals here is we want to create economic and financial stability for creators. So many creators we've talked to are living paycheck to paycheck, project to project, and they have massive followings. And there's something fundamentally wrong about that in our perspective, that they should be the primary beneficiaries, and we want to be the ones to enable that.
So I got to ask you about the investment. $4 million in seed funding led by 776 and, of course, Alexis Ohanian involved as well. How did that come together? Yeah, so interesting. We did the full road show, going out and fundraising, had talked to a lot of people. And Alexis 776, they have been phenomenal to work with, are very aligned on the vision. And they share the perspective that very similar to how putting a camera on an iPhone turned everybody into a photographer, that AI tools can help democratize storytelling and turn everybody into a creator. And that's what we believe the future looks like. They've been phenomenal in helping us bring that vision to life. And we also have some other phenomenal investors from Kapoor Capital, Impellant, as well as tech executives from Anthropic, Nike, Meta that are on board with us. So we've been able to get a lot of support and have great people on this journey with us. So at the end of the day, Lumi is a tech company when it comes down to it. And you named a couple of luminaries from the tech world. Did you tap contacts made during your playing career in the Bay Area where you did have access to a lot of these guys?
There have been a lot of people that have helped me on this journey to get to this point. It has been years of development, years of building relationships, and also years of understanding the impact of AI, how it can actually be utilized, and how it can benefit creators. And all of that has finally come together into what is Lumi now.
What are you talking about right now, Colin, when it comes to building up this company in terms of hiring, as well as greater investments here? What's in the pipeline right now?
Absolutely. So we're currently in the process of expanding our team. We're hiring for both software and ML engineers, and also looking at the product and design piece to make sure that we're giving creators the best experience. So we're focused on that, but also very focused on talking with creators, building with creators, getting them on the platform to make sure that we're building the best experience for them. Without creators, none of this works.
Yeah. Do you think when we talk about content creators and kind of the financial mechanisms that how they make money, obviously a lot of that is still tethered to ads or sponsorships with corporations in some way. Do you ever see that evolving to something broader? I don't know. I have no idea what that would be, whether it would be a subscription model, but some way to diversify that revenue stream so those creators aren't reliant just on one sort of stream of revenue. And if that drives up, they're basically out of business.
Yes, very much aligned, and that's a phenomenal point. Our vision of the future is individual creators will look like Disney. They'll be able to go from an idea to a final story. They'll be able to publish that. They'll be able to merchandise it. They'll be able to do it across the franchises and stories they create, and to be able to collaborate with other creators and do that all on one platform. So that's what we're focused on building, and the experience we're focused on building at Lumi for creators.
Your goal here is definitely to solve problems for creators, for storytellers. Talk a little bit about how that connects with your own story, because obviously you had a story to tell and it was something that you wanted to have control over, and in some ways it kind of got out of your control.
Yeah, there's so many opportunities and so many stories that people want to tell, and myself included. And it's very difficult to get that done. Oftentimes, once you get a green light, it can take 18 to 24 months before that story ever comes to life, which we want to drastically reduce that time period for creators. But the other part is, in going traditional paths, oftentimes you don't have control over the story. You have input on it, but you don't have control. And that's something that, as we've talked to creators, they really want control over their stories. So they're authentic, they're genuine, they believe in them. And it comes across to readers and viewers as they're engaging with the stories as well. So it's a great opportunity for creators to be able to pull back that control.
So speaking of stories, I don't want to talk politics, but let's just say 2024 is vastly different than 2016 when you began your protest for civil rights during the national anthem. I'm curious as to how you would characterize the climate for activism in sports for professional athletes today versus 8 years ago.
I look at it very similar. It is of extreme importance. We know and we see the political landscape and the political climate. It's very important that we're active. It's very important that we're pushing forward. And on my end, as we're doing that, I'm also focused on building a phenomenal company and platform with Lumi. So it's a very unique time that we're in.
Are you done with sports, Colin?
I'm never done with sports. I'm a competitor at heart and will always compete. And this is another opportunity for me to compete. It's one of the things that I look at is any chance I have to be in a space to be able to compete, to be able to try to be better, to try to be greater. I'm always going to do that. So I still get up, I do all my training 4:30 in the morning, and then I spend the rest of my day building Lumi and very focused on how we create that experience for creators.
Just a quick follow-up question, Colin. What skills from sports, from your training, carry over into launching and running these different startups? I mean, what's the single most important transferable skill you find?
People. People are the most valuable thing that you'll ever have as a company. And we have a phenomenal team. It's something I learned playing football. And also you get the leadership qualities of playing football and specifically quarterback. Mm-hmm. How do you get the best out of people? How do you put them in positions to be successful and to win at what they're doing? And if you don't have that, it doesn't work. It doesn't matter how good your game plan is. It doesn't matter how good your strategy is. If you don't have the right people, it doesn't work. So we have phenomenal people on our team already. Yeah. We have phenomenal investors that are supporting us, and we're looking to expand that team now.
All right, good stuff. Colin, thank you so much for joining us. Colin Kaepernick, CEO and founder of Lumi Story AI, and of course, the former quarterback for the San Francisco 49ers. Great to see him, and I'm glad he said that he's not done with sports yet.
Yeah, although maybe I guess if this takes off, he won't need sports anymore. Though.
Yeah, they'll be coming to him.
Yeah, but it's interesting too. I mean, because I did when he started that media company, there was a lot of talk about kind of, why it kind of petered out, and he kind of addresses some of that with why Lumi came to be here. So kind of interesting to see how it's kind of come full circle.
Yeah, the obstacles they face and the solutions that he's now offering a lot of these storytellers. All right, let's take a look at how markets closed on the day, because it was a kind of a swoon into the close. You can see the S&P 500 closing lower, as did the Mag 7. So extending those losses from yesterday, the big sell-off yesterday. But the Russell 2000 small caps and in fact the S&P 500 equal weighted index did finish higher. So that rotation is still intact into companies that aren't big tech, that have been ignored in this AI excitement.
Yeah, it'll be interesting to see whether once we start to get some of those mid and small cap earnings over the next 2 to 3 weeks here, whether that rotation trade holds up. And of course, obviously, the Fed and the macro are going to be a big component as well.
That too. This is The Close on Bloomberg.
It's all over, what's your name? It's all over. That's not how Washington should run. And under Kamala Harris, people's voices will be heard in a very different way than you're trading at the table with big oil, big pharma, big guns, big money. It's about the people.
That was Nancy Pelosi, the former House Speaker, singing her praises for Kamala Harris to take on Donald Trump. So let's talk about politics right now, the latest, and bring in Bloomberg Balance of Power co-host Kailey Leinz. Kailey, Kamala Harris trying to get backing from labor unions, speaking before them. Give us the summary of what she told them and how successful that's going.
Well, Scarlett, essentially, this is an extension of what we've already seen from the Biden administration. Remember, President Biden has asserted that he is the most union-friendly president of all time. And she definitely does seem like she's trying to follow in those footsteps, in the fact that the union vote is going to be highly critical in this election, especially when you think about the swing states in the so-called blue wall, Wisconsin, Michigan, Pennsylvania. The union vote is going to be critical. Now, she wasn't speaking to a union in those states today. She actually was in Houston, Texas for the American Federation of Teachers, but she was talking about the contrast between the kind of pro-union policy she would pursue as president versus Donald Trump, and specifically Project 2025, which of course was technically put out by the Heritage Foundation. Donald Trump has tried to distance himself from it, but a lot of people in his orbit were contributors to that project, and it includes things like eliminating the Department of Education, some less union-friendly policy ideas as well. So that's really what she was focused on. But of course, she's now back here in Washington getting ready to meet with Israeli Prime Minister Benjamin Netanyahu after yesterday not presiding over his joint address to a joint session of Congress.
Give us a sense here. It's interesting. We talk about the contrast between these now two presidential candidates, assuming she gets the nomination, the formal nomination. But we haven't talked a whole lot about those policy differences. And it's interesting you bring up Project 2025, which, of course, President Trump has kind of tried to distance himself from. Yep. But is there a sense here that if we do get a debate amongst these two here, it will be on those policy issues? Or is this really going to be a campaign that's going to be decided more so by personality, charisma, et cetera?
Well, of course, we've seen personality be a big contributor to this campaign thus far, but it could potentially be more about policy now because the age issue that surrounded President Biden was removed. So if the Republicans want to go after Kamala Harris, it's not really easily done when she's nearly 20 years younger than Donald Trump. It really is in areas of policy, like, for example, the border. The House of Representatives just today on mostly the party line, although 6 Democrats joined in voting for this resolution to condemn Kamala Harris for her role as the quote-unquote border czar earlier on in the Biden administration when she was charged with tackling the issue of migration from some of these countries and the root causes of what is driving people over the southern border. So issues like that, you are seeing Republicans trying to draw a contrast with her. She, of course, is trying to contrast herself with Republican policy platforms when it comes to things like education and unions. Also, the issue of abortion, we have already heard her speaking a lot about. She actually released her first ad today. A digital ad that basically is all about freedom, including the freedom to make choices around your own body, et cetera. And that's important because to this point, in her very short tenure as a presidential candidate, Donald Trump and Republicans have been outspending her something like 25 to 1 on
Just real quickly, Kailey, only have about 10 seconds here. Any news at all on a potential VP candidate for her?
Not yet, but the clock's ticking. They have to nominate that person between August 1st and 7th because they're going to be doing a virtual roll call before the convention, Romy.
All right. Well, my math tells me that's just about 2.5 weeks away. Kailey Leinz, you can catch her and Joe Matthew every day, 5 p.m., top of the hour on Balance of Power. Stick with us. A lot more coming up, including some of the big events that could move markets tomorrow, including a big inflation report. This is Bloomberg.
On the calendar tomorrow, the Fed's preferred inflation gauge due out at 8:30 a.m. with the headline year-over-year figure expected to come down to 2.4% from 2.6% previously. Yelena Shulyatyeva, senior U.S. economist at BNP Paribas, joins us now to discuss. So how are you thinking through what the core PCE number, which is the big one that the Fed pays attention to, changes or gets tweaked a little bit in light of today's GDP numbers?
I don't think it changes the whole perspective. It's still slowing from the first quarter. We did get a little bit of a hint today in the quarterly GDP numbers. So we got the quarterly core PCE reading, which was slightly higher than consensus expectations. So that, at the face value, suggests that we may see a little bit of a stronger number than consensus tomorrow for core PCE month over month. So, but, you know, all in all, it's still slowing in inflation, and that's a green light for the Fed to go in September.
And I think that's a key thing, right? Today's GDP report kind of gives the Fed some breathing room to not have to move right away in July, as some former Fed officials, Bill Dudley, the former New York Fed president, have prompted or suggested.
Totally. I think it's strong. It's still solid. And, it gives them some breathing room, as you said. Consumer spending was strong, business investment too. But I think, today's number overstates a little bit the underlying pace because I think we see some hints of companies trying to stock up ahead of tariffs. So like we saw that in inventories accumulation, we saw that in business investment. That was likely driven a lot by companies purchasing a lot of stuff, including computers and peripherals ahead of expected tariffs. So that may be borrowing some strength from future GDP numbers. But all in all, again, this is a good number.
But that brings up the question, too, as to how reliable the number is, right? I mean, everything you're saying there means that the Fed has to now assess sort of what's actually driving these numbers. And if you can't come to that conclusion, or at least you can't come to an accurate conclusion, then you are at risk for a policy mistake, right?
But consumers are good. Consumers are still spending. We saw goods spending rebounding, and even if services spending slowing down a little bit.
You saw that in the second quarter. Is that based on your research? Do you think that's continued here in the third quarter?
I think it will continue, but it will be a little bit slower, just because policy is making its way through the economy, and higher rates are percolating into the economy. So consumers are becoming more price sensitive and spend less.
Does it matter if the aggregate level of spending holds up? Does that matter if the type of spending, meaning it changes if consumers are trading down to other things or maybe not buying discretionary items but buying staples? Does that matter?
I think so. But at the same time, we do see discretionary spending from higher end consumers they were still spending on vacations. We were talking about going on vacation just before the show. So I think people are still spending on those things, and they're very discretionary. So it's really bifurcated. For some people, it's really spending on food and necessities. For others, it's still spending on other things that supports economic growth.
And you saw the story on Hermes earlier today. Here, everyone's still buying Birkin bags for some strange reason.
Well, because there are not enough of them. That's why. You have to wait in line.
But that's why the Fed needs to be proactive and do it before, be ahead of the curve and start that cutting cycle. It's not an easing cycle. It's a cutting cycle ahead of the time.
So it'll start cutting rates, you believe, in September. And how many rate cuts are we going to get this year?
In our forecast, we have 2 this year, September, December, and 4 cuts next year.
And September's not too late for you?
I don't think so. I think the economy is on a solid footing still. We'll see the payrolls report again, but
that's after the FOMC. So.
All right, Yelena, always wonderful to have you in person. Yelena Shulyatyeva, senior U.S. economist over at BNP Paribas. Look some of the big potential things that could move the market over the next 24 hours. A few of the things that we are keeping our eye on, Scarlett, is what else? Earnings, some big earnings coming out in the morning.
Yeah, 3M, it's had its issues, certainly. There's a new CEO that was announced, and of course they had a lot of legal liabilities that they need to work through at that company, but an industrial name, and we know that industrial names are getting a second look right now with people rotating out of big tech. There's also Bristol-Myers Squibb and Colgate-Palmolive, so we really start to hit some of the other sectors within the corporate sphere.
And of course, we go back to that economic data. We've been talking about the PCE, both personal income and spending, and that price index important at 8:30 a.m. We also get a read on consumer sentiment too, Scarlett.
Yeah, the University of Michigan Sentiment Index will come out, and of course people will pay a lot of attention to expectations for inflation, particularly for 1 year and for 5 to 10 years out. Right now, the consensus estimate is for an increase of 2.9%.
And those numbers have held up somewhat. I know they've kind of ebbed and flowed a little bit, but we didn't see this consumer sentiment fall off the cliff.
No,
it almost seems like when you look at consumer surveys and the corporate CEO surveys, it seems like the corporate executives are more dour on things than the consumer is.
Yeah, well, the consumer continues to spend, and we've seen that. They might be choosier about how they're spending, but they're spending.
Yeah.
Apparently on a lot of Uggs.
Uggs, and Bentleys too. They're popular these days. We're also going to go back to the world of politics. Israeli Prime Minister Benjamin Netanyahu here in the United States. We know that he is scheduled to meet with former President Donald Trump.
He's going to make his way over to Florida, meet Donald Trump at Mar-a-Lago. Of course, he did meet with President Biden and is meeting with Kamala Harris, the vice president, today.
Yeah. Oh, that's right. Yes. Well, Kamala Harris. So he's making the rounds here, I guess, covering all his bases.
Yes.
Depending on how the U.S. election shakes out in November. We should also point out the G20 finance ministers and central bank chiefs gathering in Rio de Janeiro and in Paris tomorrow. Scarlett, it's finally here.
The opening ceremony. It's going to happen during the day, our time, but of course that means we all go home at night to watch what happens in the City of Light.
Yeah. Anyway, I like it. I love the Olympics. I'm always excited for us. We'll have coverage of the Olympics and, of course, everything that goes on in the markets right here on The Close. Please join us tomorrow. In the meantime, stick around. Balance of Power is up next, right here on Bloomberg.